All right, guys, we're back again with another great episode of PFREI. I'm your host, Fuquan Bilal. Today we have Clay Rockwood from Utah. We're going to get all into your background. Clay is part of the Collective Genius, which is a mastermind I'm in. And I'm really actually going around a circle, inviting a lot of the guys who are in the mastermind Collective Genius to the podcast, just to kind of get a temperature of the market, where they are, and just to really find out more about what they're doing and how are they pivoting into this marketplace. So I really thank you for coming on the call and spending some time to kind of share with us. I like to bring people who are actually operators, people who are actually doing, people who's probably going through the pains now and went through the pains before and trying to figure it out like the rest of us. So without further ado, if you can give the background to your audience, and talk about your company, and then we can get into the podcast.
Yeah. Well, thanks for having me on, Fuquan. So yeah, like you mentioned, I'm here in Salt Lake City, Utah. Got into real estate back in 2008, right during the last recession that we went through. So I've really only seen kind of an uphill, momentum since then, but I've learned a lot of lessons watching others go through, the 2008 crash. But basically started my career as a real estate agent and broker representing clients. Didn't really love doing that. Knew I wanted to be in real estate in some capacity because really what excited me about it was just the opportunity to have passive income and, financial and time freedom. So I thought I'd gain that by being an agent, kind of being my own boss, but realized soon after that I was still a slave to my clients, working nights and weekends. So that didn't really interest me. Fast forward a few years, started flipping homes. Me and my brother and my dad partnered up. We were the flipping brothers kind of thing, right? Flipping homes, and which was great. We still flip homes on the side, but again, same kind of thing. It was very transactional, good times, bad times. I was finding as the market was getting hotter, in 2012, 13, 14, 15, that kind of era, that it was harder to find my own deals, right? I was getting beat out by wholesalers and just other investors. So that's when I started looking into wholesaling or marketing, right? I was really looking into how do I market and find my own deals off market. And that's kind of led me to wholesaling. So back in 2017, partnered up with my business partner now, Brian, and we started wholesaling single family homes, right? Did a ton of marketing direct to seller, started building a team and really gaining momentum. And the interesting thing is, as a byproduct of our marketing and doing a lot of the direct to seller stuff, postcards, cold calling, all that, we were finding these off market multifamily deals, right? Sometimes small duplex, fourplex type properties, sometimes larger 10, 20, 30 unit type properties. And we just started acquiring those kind of on the side, really, as a byproduct of our wholesaling operation, until that kind of gained enough momentum and a lot of people started seeing what we're doing. And we had a lot of people that would come to us and be like, hey, I want to learn how you've been able to acquire all these doors, right? How have you done this? How'd you find them? How'd you fund them? All that kind of stuff. How do you underwrite the deal? And so, just kind of out of necessity, we started focusing a little more energy on the multifamily side. And until now, the present, we're full all in on the multifamily. So we have a whole separate team devoted to just finding multifamily properties, mid-size up to large scale deals. And so we have a small portfolio now of about 350 doors. Here in Utah, some out of state. We own a deal in Ohio, one in Texas and Indiana and things like that. So it's just kind of, over the last 15 years, I've gone from multiple different niches within real estate, but really have found my true passion in the multifamily space.
Wow, thanks for the share, man. I often think, because I'm doing an out market here in New Jersey. I'm just so addicted to fix and flips, right? that those chunks of cash are just so sexy.
Yeah.
When you at the closing table, you get a nice big hit. You just so addicted.
Yeah.
And we've done rentals also. That was the mistake that I made. I heard you mention 2008. I lost a boatload of money in 2008 because I was just doing fix and flips. I didn't have any rentals. So what you're doing is very smart. Cash flow is king, especially in this market. Finding assets where you can add value and really increase rents to the point where you increase valuation of the property, force appreciation, where you can refinance out and just keep that rental going on and on and on. So you're definitely in the right place. I had to learn after the market crashed that, being a landlord is not bad if you can outsource it to a reputable property manager. I think that's the biggest challenge. If you're not vertically integrated and doing it yourself, the biggest
Mhm.
challenge is finding a company that will pretty much have your back, won't cheat you, and do the right thing. They're out there, but it's hell finding them. And
Yeah.
when you do find them, you just want to stay specific in that market where they are, so you can grow there and leverage their experience until you find others that do the same thing. So yeah, definitely on the right track. Um, what I was alluding to was that I was sitting down the other day and going, we have a two-pronged strategy where we're doing fix and flips and we're doing some rental stuff in the Southeast region.
Mhm.
And I'm like, okay, do I make a pivot now to do all rentals? Like, I just don't want to be stuck in one asset class. I know the one thing is great to focus on, but you know, I just something is telling me to keep doing what I'm doing. We're right in New York, and we're not spreading ourselves too thin at the moment. So, but
Yeah.
anyway, why are you passionate for real estate?
I kind of alluded to it before, but I've never found something that provides the wealth building opportunity. So the ability to make as much money. I know doctors, lawyers, attorneys, engineers that have spent a lot of time in school and are well into their careers, and I look at what they're making every year, and I'm like, I can make 10 times that in real estate, right? So the opportunity is there to just make a lot more money. First of all, I believe in real estate. And second, like you mentioned, the passive income. It's one of the only asset classes out there that provides truly passive income. Now, if again, like I mentioned, my story and kind of like you mentioned, you do fix and flips. Well, fix and flips are not passive, right? You're
It's
very
work.
actively involved in that business, right? You
Very
have
active.
find the deal, work with the contractor, make sure everything's going. It's just, that's an active business. Now, when you get into the commercial space, and I would even say like single family rentals, yeah, unless you're going to outsource to a good property manager and they're very competent and can handle everything, that's different. But for the mom and pa type operator that maybe own a rental or two, they're going to just manage it themselves, and that's not passive. It's very active. You got to find new tenants. When a tenant moves out, you got to go paint the property, go fix toilets, fix furnaces, right? So I was always looking for something that provided actual passive income, meaning money made to me where I did not have to do any work at all. And that's what I found in multifamily, especially mid-size and large multifamily properties, where our investors, right? So we're syndicating deals, we're raising money from investors. And I invested in other people's deals as well, not just our own. But I love the option where I can put my money with someone else in a syndication or a large scale deal, and it's truly passive income. I get money sent to my bank account every month or every quarter without me having to do anything.
Yeah.
Right, and that's just amazing. And on top of that, the reason I'm passionate beyond that for real estate is the tax benefits. Right. So when you start making a lot of money, and that's what a lot of people don't realize, is like even flipping homes, that's kind of what that triggered it for me. There was a year about 3 or 4 years ago when I remember my CPA called me up. He's like, Clay, you have to write $100,000 check to the IRS. I was like, what? He's like, yeah, I mean, you made X amount of money and now you owe that, this amount to the IRS. It's like, that is ridiculous. I spent a third of my year just making money for the government. So you start thinking differently when you start making different levels of income, and you start thinking more tax strategy, right? And so with depreciation, and now especially this year, which is the last year of the bonus depreciation, 100% bonus depreciation, there's just so many tax benefits to owning large scale multifamily and commercial projects in general that, I mean, I don't pay any tax anymore, right? I'm making more money and paying less taxes. So, and that's not doing anything illegal. That's 100% legal. The IRS provides those opportunities. So for me, it's a combination of all those things. How do I make passive income, build a generational wealth that I can pass on to my heirs, my family, and reduce my tax burden? So I don't know of any other asset class that you have that kind of control and opportunity. Even stocks, I mean, things like, they don't even compare. Doesn't even come close. So That's why I'm so passionate about real estate. Everyone I talk to, I'm just like preaching this, like, you got to buy real estate. It's amazing.
Yeah, that's awesome, man. It's wonderful when you can find something that you can control and be passionate about, where you're not burnt out about it, right? So I'm pretty sure it's just not, you put your feet up and your hands behind your head and it's smooth. I mean, you're actively managing your passive investments.
Yeah.
Because you're running a syndication, so there's some active management there, especially for the investors, but it's not as much as the mom and pops are doing with the turnovers and everything else, because you're outsourcing all of that. And it's pretty much you're just managing data, making sure the vendors are doing what they're supposed to do, and holding those guys accountable to reach the targets that you set in your pro forma, right?
Exactly. Yep.
What are some of the challenges you're seeing now? Because you hear a lot of guys who play the multifamily space, who took the short-term lending. They didn't get agency debt in place because they had to close quick. They made all these promises on syndications, and they have short-term money that's coming up, and the rates with agents, if they're not occupied 90% or more, they can't get agency debt, so they have to get extensions, and those rates that were probably 5 or 6 then are like 9 now, and those guys are in super duper trouble. So
Yeah.
what is your take on are you starting to see a lot of that stuff coming to the market? What's your take on that part?
Definitely. Yeah. I think I saw a stat just today, actually. I can't remember the exact figure, but something like $20 billion worth of multifamily specifically is on bridge debt that's going to be coming due in the next year to 2 years.
Wow.
So, you're talking $20 billion of real estate that is on a debt structure that they're not going to be able to refinance. So they're going to have to sell. They're going to be forced to sell. And lenders, when you think about it from the lending perspective, lenders are not going to be as eager to work with these people to extend or modify the loan terms, because they've lent money out at a 3 or 4% interest rate, where now they can lend it out at a 7, 8, 9% interest rate. Lenders are incentivized to like, no, get this off our books so we can go out and lend this money at a much higher rate and double our money, right? So you kind of have this combination, like you said, of massive opportunities coming up, I think, in the next year to 2 years, where we're going to see just amazing opportunities, and we're gearing ourselves up for that. And I think there's going to be, I'm already seeing it now in deals that are out there now, but sellers are much more willing to do seller finance terms to carry the note, right? So I think if you can get savvy and understand how to structure those types of deals now, it's just going to set you up for success in the next couple years. Most of our deals that we're buying now, we're structuring with some sort of seller finance or creative finance built in.
Yeah, I was just talking about that 100%. Yeah.
So I think you just have to see kind of the writing on the wall, see what opportunities are going to be coming, and get your knowledge base to a point where you can understand how to capitalize on those opportunities when they come, because they will come. If you're active in this space and you're doing deals, right, you're going to have these opportunities come to you. You just have to be able to implement it when they do come.
Yeah, everything we're making our offers on is seller financing.
Yeah,
everything. No
Same
other
here.
way.
Same here.
Every multifamily deal, we just got a 200 unit in front of us, and a lot of these buildings, the owners own outright, the mom and pops with no mortgage on it. You scratch your head and like, wow. And they've owned it for like 20 years, and the market's appreciated so much.
Yeah.
Where there's so much value, and they're like, you know what, I'm gonna sell it. So our thing is, hey, you don't want to get that big tax thing. You just want cash flow, right? Let me give you 20% down. You play the bank for 3 years. You hold the loan, hold the debt. We'll refinance out. You know where the market is at, right? If you try to sell it, this thing is not 90% occupied. People are not going to be able to get the financing they need. You're going to have to own a finance if you want to sell now.
Yeah.
So, just hitting those pain points, coming into an agreement, showing them your track record, will definitely help you, acquire more deals that way. So I hear you loud and clear. If you are skillful to be able to position yourself to offer seller financing or to negotiate seller financing with the seller, definitely do that and focus on that.
Yeah.
Something you mentioned, which you said is $20 billion in bridge debt. Over the next 2 years, we're going to start seeing that. I would definitely say, look at the stuff that's coming to close. I would say Q1 and Q2. The guys that are their debt is due in Q1, they're already trying to pivot and make moves. So those are the guys who are in trouble right now. And there's some guys who, debt is coming due to end of Q2. We already know rates are going to be increasing. Like, we don't know what's going to happen in 2 years. There might be helicopter money flying out the sky again, and rates might go down. And, we keep getting all excited, like it's coming. And then the government do something to lower interest rates. We're like, like everybody thought after COVID, it's going to be, we were all saying, COVID, we're going to have so much opportunity. And then it was completely the opposite. So I would kind of focus on, what's happening in the next 6 to 9 months. We kind of know the story, what it's going to be, or at least for the next 6 to 9 months. So for those of you who are looking for those opportunities, laser focus on debt that's coming due, bridge that within the next, 6 to 9 months. And that's where the majority of the opportunity, I believe, is at with those syndicators. That's going to be trying to get rid of stuff at, low ball in price, because it was crazy out. It was something on the market, people doing money hard, unforeseen, money go hard day one. It was just crazy.
Oh yeah, it was great. Yeah. And the interesting thing is, so we're closely tied in with a lot of the bigger groups, multifamily owners and operators around the nation. And they've all told me that either their group or the big hedge funds like Blackstone, right? They're pencils down right now. They're not even underwriting deals, right? So a lot of the bigger groups, they're just they're stopped. They've completely stopped buying, and they're just waiting. Right now, that does a couple of things. It provides opportunities to us, or maybe guys that are smaller, right? Whereas 6 months or a year ago, we're competing against them. It's impossible. You can't compete against a Blackstone. Their money is so cheap they can buy for whatever price they want. It doesn't matter. But what I've seen is that there's less big groups out there buying or competing. So there's opportunity even now, for kind of the smaller guys to get in there and find opportunities. And that's just a sign that if the big guys are waiting, there's massive opportunities around the corner.
Yep. And we're more local to our market. So we can, get in, structure those deals, boots in the ground type deals and make it happen, especially if you're local in your market and you're out there kicking the tires yourselves and making those connections directly with the brokers. So it's more flexibility when you go that route. So let's talk a little bit more about the challenges you're seeing in your marketplace. What are some of the challenges that you're seeing in the multifamily space, primarily, I guess, in Utah? What are some of the challenges you guys are facing, and how are you overcoming those?
Yeah, good question. Well, first of all, Utah, one of the biggest challenge is affordability. So Utah is very competitive markets like Boise, where prices just skyrocketed over the last several years. 20% increase every year. So we're definitely in an appreciation market where, prices have just been out of control, and which has caused obviously multifamily to do the same. So that's why we've pivoted, and most of the what we're buying or looking at is out of state, right? In markets that are still affordable, that you can still get good returns. So Utah's an interesting beast where you just can't really make things pencil here unless, again, like you're saying, you can kind of go around the back door and go direct to seller and work something out there. But any on-market deal is just astronomically priced, and I think sellers still haven't come to terms with that yet, both on the single family and the multifamily space. So Utah's interesting in that sense. But the other thing I was going to say is, I think what's important is, especially right now, is making sure, we talked about seller finance, but also making sure your debt moving forward has good terms. Like, for example, we just closed a 44 unit townhome deal out in San Antonio, Texas. And we had a bunch of different options for bridge loans, 2 or 3 year, interest only loans. But again, those are the guys that are getting crushed right now, or like we're talking about in the next 2 years are going to get crushed. So we always try to structure our debt to give us a long runway. So I think debt structuring right now is going to be how you're going to make your money in 5 years or 7 years, right? So for example, we just closed this deal on a 7-year term. So we have a loan for 7 years at a 5.1 interest rate. So great interest terms. I mean, 6 months ago, that would have been high, but 5.1% interest rate right now on a commercial property is a pretty good deal. Interest only for 2 years, but fixed rate, there's not a floating rate. So that would be my recommendation to those that are doing deals or wanting to do deals. Make sure your debt, your loan has favorable terms that are going to give you multiple exit strategies and safety, even if the rates do rise, right? Because again, I know a lot of guys on floaters where it's like variable interest rate. Well, okay, if the interest rate goes up 2%, I mean, that crushes your NOI. That's going to crush your cash flow, right? So don't put yourself in that situation. Structure your debt in a way that gives you a long enough runway to adapt to whatever market conditions happen. So if you want to sell, in 3 or 4 years, well, that's great, but structure your debt to give you enough runway to, let's say in 3 or 4 years, the market's even worse. Well, I'm not going to want to sell then. I'm going to wait and hold for another 2 or 3 years until the market conditions turn around. So I think the smart guys right now are the ones who are really kind of taking that risk assessment and saying, okay, how do we mitigate these risks? I'm going to still do deals in this market, and there's still opportunities for deals. It's not the time to just sit on the sideline and do nothing. But it's how do I hedge the risk, right? And so that's kind of what we've done, at least initially right now, is to pivot. It's like, okay, we need to make sure we're underwriting our deals correctly. We're buffering our cap rates. We're going to exit at a higher cap rate than we probably think we will, but hey, that gives us some room, right? And buffering our loan terms, giving us more runway. So it's just taking all the little pieces that I think you could get away with over the last 5 years with making errors and making assumptions, or hope. Right? Oh, well, the market's going to keep going up. I don't have to really worry about that. Well, those days are gone. You really have to be solid on your numbers and protect yourself and your investors if you're bringing on capital, right? To make sure you're making a good deal right now, and that's going to pay off in the next 5 to 10 years.
Absolutely. I don't know who's hoping in this market. Last I checked, Hope was the name of a stripper. I don't know who's hoping in this market.
Exactly.
So yeah, you mentioned a lot of great things, man. So you were talking about those terms that sound like a local community bank, credit union, local bank. Is that where you're finding that financing at in San Antonio? Is it a local bank or is it a broker who's helping you source these terms?
Good question. Yeah, we do use a broker. So on every deal, we shop it around, right? Even if we have good relationships, you always want to shop it around, make sure you're getting the best deal. We've done a lot of our deals locally. We're with local credit unions. They know it. They are comfortable with the asset. But this one in San Antonio was actually a Freddie Mac loan. It's a non-recourse loan, which is great as well, right? Non-recourse loan. Yeah. So this was through our broker, but it's a Freddie Mac loan. Got just great terms on it. And so yeah, again, we shopped it around. We had a bunch of different options from bridge loans to some local credit unions, but at the end of the day, we found that these were the most favorable loan terms. So we ended up going with them. But yeah, I think it's important to have a great relationship with a good mortgage broker. That's just your guy, right? Hey, I bring you everything. You go shop it around, find me the best deal. I think you should do that on every deal.
Yeah, because they have more options than you will, right? They have a list of 100 plus relationships they can leverage and have those guys fighting over terms. Yeah, this was really great, man. It was great connecting with you, learning more about your marketplace, which is San Antonio, Texas, and where else?
Utah. So we buy in Texas, Utah. Dallas, Fort Worth, Utah, Indianapolis, and Ohio.
So learning more about those areas and the challenges you're facing. I got a lot of great juice for this. I took a few notes also from some things that you mentioned. And thanks for coming on and sharing. Anything else you'd like to share with our guests? Ways that, if investors want to learn more about what you're doing, how they can contact you, get in touch with you, any websites, anything you want to plug?
Yeah, for sure. Yeah, if people want to learn more about us and contact me, you can go to our website. It's soarcapitalgroup.com, SOAR. So soarcapitalgroup.com. You can contact us there. And obviously on social media, I'm all over social media at Clay Rockwood. But happy to help. That's my big thing, man. I'm an open book. If we have coaching students, I mentor a bunch of people. So if anyone needs help in the multifamily space, underwriting a deal, knowing how to structure deals, feel free to reach out. I'm more than happy to help out.
Awesome, man. Another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. This is a great episode. Make sure you guys check us out on our YouTube channel and all the other social media platforms, iTunes. Be sure to subscribe and like. Really appreciate you guys and stay tuned for the next episode. I'm out.